And Mary Schapiro is certainly one of the most powerful women here in Washington, joining me here on the sidelines of this conference. Thank you for the time, first of all.
Thank you. It's my pleasure.
First chance for us to talk with you since the flash crash report came out. As you know, there's some skeptics out there, market participants, who say, how could a single trade have triggered the mayhem we saw on May 6th? What's your response to those skeptics?
Well, I think the report actually lays that out pretty well. It was already a pretty tense day in the markets. They were down fairly dramatically during the course of the morning. And then when this extraordinarily large 75,000 contract sell order for S&P E-mini futures contracts hit without human intervention, so hit quickly and rode into the market very fast. I think it took advantage in the sense of a fragile market to start with, and really drove the market down, burned through all the liquidity. There were no real fundamental buy side, no fundamental buy players in the market pretty quickly, and had the impact that we laid out in the report.
There's some people out there saying it's even more unnerving than what they knew before. This report has come up with this one trade. How could a one trade have played this role, this cascade of effects? There's some people who are voting with their feet to some extent and taking their money out of equity markets. What's your message to them?
Well, I think there are a couple of things to say to that. First of all, as you'll recall, right after May 6th, we brought all the exchanges to Washington and sat down with them and said, how do we prevent this kind of an event, even before we fully understood that the trigger was this very large futures order? How do we prevent this from happening again, and how do we prevent this from hurting individual investors? And so we put into place single stock circuit breakers. Initially on the S&P 500, we expanded it this summer to the Russell 1000 and a lot of ETFs. And I think those will help to stabilize the market, because they'll pause trading in a stock that's moved 10% in 5 minutes, give the market makers the time to gather liquidity and to reopen the stock in an orderly and efficient way, so that investors can have confidence that if the downward movement was because of some aberration as opposed to fundamentals, that the stock will be able to reopen at a more realistic, fundamentally based price.
But you and Gary Gensler have both suggested, the chairman of the CFTC, that other investor-focused measures might be necessary. Give us a sense what's on your radar.
Sure, no question. Well, the report is now out there. The goal of the report was to try to define the events of that day, the triggering, and then the frailties in our market structure that allowed it to have impact in both the futures and the equities markets. Now that that's out there, it's gone to our advisory committee that will come back to us with a series of recommendations. That said, there's some things we're looking at very carefully. For example, should algorithms be required to be programmed with risk management controls in them, so that it throttles back the algorithm that's selling or buying based on a computer program when market conditions change, or not susceptible to that order being executed in an orderly way. We're looking at the SEC at whether there should be some market maker obligations to maintain a two-sided quote that is reasonably related to the national best bid and offer. We're looking at whether there should be negative obligations on market makers not to take liquidity out of the market when it's moving dramatically.
Would that include high-frequency traders who right now don't face that obligation?
Well, we're looking at high-frequency trading very carefully, as you know, and have been for some time, and making some preliminary decisions about whether they should be regulated with respect to their quoting and trading strategies. So there's a lot of work to do. There are a lot of ideas on our plate, and now that we have some definitive answers about May 6th, we're going to move forward.
Move forward. Can you give us any sense of a time frame?
I really can't. We want to hear back from our advisory committee, obviously. You know, it's a tremendously talented group of people, and we want to hear their input now that they have all the facts and information about what their thoughts are.
All right. In addition to the flash crash, you've got the implementation of DoddFrank, at least 100 rulemakings, more than 100 at the SEC. Where do you stand on that? And more importantly, there are new questions being raised about whether or not you and the other agencies are going to get the resources to actually implement these rules. What's your take on that?
Well, that's a little bit worrisome. We do have over 100 rules at the SEC to implement, more than 20 studies to conduct, and we have to actually create 5 new offices within the SEC, 4 of which report to the chairman. So we have a lot of work to do. We've staffed it well, I think, for getting rules proposed and ultimately adopted on the statutory timeframes, but we need significant new resources to develop, for example, a regulatory regime around over-the-counter derivatives that have never been regulated before, around hedge funds that haven't been regulated before. We have heightened responsibilities for credit rating agencies. So there's a lot for us to do. We need the resources to do those things to the standard that I think Congress expects of us and we expect of ourselves.